So you've been saving up and you just bought your dream car, the Dodge Viper. Now you're probably thinking about buying car insurance for protection. You call your insurance agent and agree to pay them a premium every month in exchange for an insurance contract to take on the risk of your Viper in case you crash your car. This is the same exact concept as options. Instead of buying a Viper, let's say you're an investor who owns 100 shares of AMD at $95 per share, or $9,500. That's $9,500 at risk. And just like how you bought insurance on the Viper, you want to buy insurance on your stock. You can do this by buying a put option contract. Just like how you had to find someone to sell you insurance on your Viper, you will find a trader who will sell you a put option and agree to take on the risk of your stock in exchange for a payment. Let's look at two scenarios. Scenario number one, AMD is at $100 per share at the end of the contract. The put option would expire worthless. The trader who sold the put option contract makes $200 and is thinking, well, that was easy money. And the investor who bought the put contract makes $500 on the stock, but loses the $200 premium, netting him $300, and is probably thinking, what a waste of money. Scenario number two, AMD is at $84 per share by the end of the contract. The investor who bought the put is thinking, at least I bought insurance. Remember, since the stock is below the strike price at expiration, the buyer of the put would sell 100 shares of stock at the strike price, or $95 per share. Now, you're probably tired of hearing the car insurance analogy by now, but it illustrates the concept well. Just like buying car insurance, you don't keep the premium you paid, or in this case, the $200. This would result in a net loss of $200 for the investor, and that's better than the $1,100 he would have lost without insurance on the stock. What about the seller of the put option? Since the buyer of the put sells 100 shares of stock at the strike price, the seller of the put would buy 100 shares of stock at the strike price, or $95 per share. The trader is probably thinking, well, that's one way of acquiring 100 shares of long stock. The trader would own 100 shares of AMD at $95, and of course, he would keep the premium of $200. Now it's up to the trader to decide if he wants to sell the stock and take the $900 loss and move on, or just hold on to it for the long term. Now, as an investor, if you're wondering, okay, the stock sold off, so what? I don't want to lose my shares just because I bought insurance. I would rather keep my original 100 shares and buy more to dollar cost average. The cool thing here is you don't have to hold your option contract till expiration. Back to the car insurance analogy. When you drive a car, you have to have insurance. It's just the law. With options, you can bid your contract to another trader or investor. If you're wondering, since you can bid on options, do you even need to own the stock? This is the cool thing about trading options. You don't need to own the stock to trade them. If you're new to options, I hope this analogy helped clear up the concept. If you've seen value in this video, please subscribe, click the like button, and comment below.